No, it is wonderful to be back. Good afternoon, Cal Chamber and guests, as the case may be. Eh, Wonderful introduction. There's so much to talk about. I want to get through a bunch of stuff here. Just a quick reminder, Beacon Economics, as noted, we started the company almost 20 years ago. And over the last 20 years, what I've tried to do is provide analysis to both public and private clients, which has a very simple mandate. What we try to do is let the data tell the story, rather than, shall we say, start with the story and force the data to confess, as is often the case. And I got to tell you, as the years have gone on, I knew when I left UCLA, I knew this was going to be hard to do. What I didn't appreciate was how much harder it was going to become over these 20 years. And that is exactly what's happened. I've watched our world, if you will, become continuously disengaged from what I see in the data on a day-to-day basis. And honestly, that is probably the largest risk that we face right now, and that's one we're going to be talking about quite a bit today. And to understand that, and also understand that what I've had to do is go back and think a lot about what I learned in grad school, and probably what's more important, what I didn't learn in grad school. And what you see today, what you see on my presentations, is really the accumulation of all this learning over all these years. And it boils down to the fact that today's presentation is going to have two major parts. One part is going to be what we think is happening in our world, our social narratives. This is what you hear on political campaign trails. This is what you see screaming at us in the headlines. And then, of course, we're going to talk about what's actually happening in our world, which is not the same thing. And this, by the way, is something I have really begrudgingly had to come to acknowledge, because when I was a grad student in economics, we were taught the rational agent theory. And the rational agent theory says that people internalize information and make the best decision they can. And, you know, honestly, I don't know, the only thing I do is go in the real world and open my eyes to realize that rational agent is not something you apply to the vast majority of human beings. Now, ultimately, this is important from a forecasting perspective because, you know, narratives drive decisions, the decisions of households, the decisions of businesses, the decisions of investors, and, of course, most of all, the decisions of policymakers. And if you want to be a good forecaster, you have to pay attention to why people are making decisions, but then you also have to acknowledge what outcomes are actually going to occur as a result of those decisions. And that answer can only be found, of course, in economic theory and the data I study on a day-to-day basis. And what comes out of this, of course, is that good choices and smart policies start with the correct narrative. And this is one of the reasons why I'm happy to work with Cal Chamber. I'm happy to work with chambers across the state, because in the end, when I look at chambers and I think about what chambers of commerce do, well, I see them primarily, and I realize there's a lot of things that chambers do, but I see them as the group that is in charge of driving the narrative to where the narrative needs to be. That is what we all need to be thinking about. How do we get the narrative better connected with reality? Because that is how we get the right policy choices to be made. And yeah, most of the policy choices we're seeing around us today are the wrong ones based on the wrong narratives. Now, with that being said, what is the current narrative for the U.S. economy? And we know what it is. Consumer confidence has yet again plummeted to almost record low levels. Consumer confidence right now is basically where it was in the midst of the Great Recession, when, by the way, we are not in the midst of the Great Recession. And we know, of course, a lot of this decline in consumer sentiment is driven by the huge increase in policy uncertainty, the wild gyrations in the stock market, which, of course, is all linked to the current administration, Donald Trump, and all the things that he is trying to accomplish in a very, very, very short period of time, for better and or for worse. And, of course, the rhetoric all boils down to the idea that we are highly likely to have a recession in the near term. This is an article on CNN not too long ago, how this is going to be self-inflicted. Now, before we get all panicked about the tariff-driven recession that we're about to have, let's keep something in mind. There's been a lot of recession calls over the last few years that turned out to be, well, let's just call them bunk, right? For example, in 2019, I don't know if you remember this far back, we were going to have a recession driven by the collapse of real estate. And of course, in 2020, The pandemic wasn't supposed to be a quick and dirty recession. It was supposed to be a 10-year depression, right? And that didn't quite turn out. In 2023, we were going to have another recession. That one was driven, of course, by the yield curve, and yet again, that one didn't pan out as well. What I'm trying to tell you is that the forecasting community is, shall we say, a little bit over the top when it comes to predictions. And, of course, that's exactly why John Kenneth Galbraith said all those years ago, the only function of economic forecasting is to make astrology look respectable. Now, mind you, we're not the only ones dropping some bad forecasts. Does anybody else remember when Nate Silver talked about how that last November's election was a coin toss and no one could possibly figure out who was actually going to win? And, of course, it wasn't a coin toss. It was a complete wipeout. Hence, of course, all those headlines. And that brings me to my new expression, which is the only function of election polling is to make economic forecasting look respectable again. So thank you, Nate and company. We appreciate you. We appreciate you. Now, look, I have actually raised my probability of a recession. We contribute to the Wall Street Journal, a survey of forecasters, and my probability of recession in the next 12 months is actually up to about 30%. Still below the group, but this is the first time I've raised my probability of a recession in any significant way, going all the way back to, of course, right at the beginning of the pandemic itself. And I am worried about the economy. Risks are rising, but not for the reason most Americans think. Look, ultimately, this is the narrative and the reality of our world. The narrative of the American economy is that somehow or other the average quality of life is going down. The narrative is that somehow or other a large portion of American households are on the financial brink. They're barely keeping a roof over their head and food in the refrigerator. That somehow or other this is an incredibly fragile national economy, home to all sorts of incredibly fragile American households. Yeah, no, that is not the world we live in. In fact, if anything, when you look at the data, we live in a world of record wealth, record income, and record consumption for the vast majority of Americans. Never have we had it as good as we do right now. But nevertheless, the U.S. economy is fragile. But it's not fragile because there's anything fundamentally wrong. It's fragile because our economy is overheated. Look, the real problem here is, why do we feel so rich? Well, one reason is we don't have to pay for all that government spending. We are running massive federal deficits, which makes our disposable income look a lot higher than it actually is. And of course, at the same time, household net worth is at an all-time high level because I don't know if you paid attention to this, but we have a bubble going on. And that's in the stock market, that's in the housing market, and yeah, guess what? It's even, of course, in that cryptocurrency market. So what you really see in the U.S. economy is very simple. The real problem we have here is that our economy is overheated, and you can see that primarily in our external imbalances. Our external imbalances are widening dramatically, and that is all being fueled by an incredible amount of money flowing into the United States chasing yield. Well, that's not a sustainable situation. At some point in time, we're going to have to pay the piper. At some point in time, we're going to have to recognize we're living beyond our means. Now, when it comes to this new administration, look, a lot has gone on over the last few months. There's no doubt about it. And it's been chaos and crazy. It's hard to look at the papers. That said, the vast majority of things that are going on out there right now are actually a lot more smoke than fire. A lot of the things the Trump administration has tried to do, well, frankly, they're not legally allowed to. And it's only a function of time before the courts finally shoot it down. Now, with all that being said, there are a couple things that they can do and they are doing that do worry me. And they seem so bizarrely paradoxical. On one hand, Trump is clearly trying to heat up the economy even more. He's trying to expand deficit spending. And of course, he's out there pitching cryptocurrency and trying yet again to get that bubble to expand even further. But at the same time, he's also pursuing weird policies, attacking our global trading partners, our global financial partners, the allies, the nations who are closest to us, and thereby is threatening to destabilize the very capital flows that our bubble is relying on. So it is an odd situation, but understand, it's not that Trump is rocking the boat, it's that the boat Trump is rocking is incredibly unstable, and it was started that way. He inherited that economy. Now, when does this turn into a recession? The honest-to-God answer is I don't know. Because as much as those global circumstances can start to come back to haunt us, the U.S. household, the American household, is still in this bubble of strong financial health. And the question is when do these broader circumstances finally penetrate that bubble? And that question has not been answered yet. So yeah, I'm worried, but with all that being said, it's not the current circumstances, it's the long-run circumstances we need to worry about. Now, I already talked too much. I got 30 minutes left. I got 50 slides. Buckle up, okay? With that said, at the end of this, don't try to take pictures. At the end of the presentation, in my last couple slides, there's a few QR codes. You'll be able to take a picture of that, get a copy of this in your inbox. Here we go. Okay, look, coming into this year, the U.S. economy looked great. You had overall real GDP growth running close to 3%, which is about where it should be given our constraints in labor supply. Even coming into this year, yeah, we had a negative quarter in the first quarter of the year, but that wasn't because of a pullback in demand. That was simply because of a massive surge of imports coming into the economy trying to get ahead of the tariffs. And by the way, that negative number is now going to be followed by a giant positive number in the second quarter, because guess what? Imports are now plummeting because we already got everything we needed in the first quarter of the year. That is a quarter-to-quarter bounce. There is nothing what I would call significant in terms of a trend in this particular data. And leading the show, of course, continues to be the American consumers. Foreign travel still at record high levels. Restaurant spending continues to grow, 50% above where it was before the pandemic. Vegas continues to be busy. If you want to be jealous of somebody's 10K, take a look at Live Nation, which pulled in $23 billion in revenues last year on ticket sales for concerts, because every concert's selling out, including every single VIP package. This is not a nation that's suffering. In terms of cars, I know the number of cars being sold is lower than it was a few years ago. Guess what? The quality of each car being sold is 25% higher than it was prior to the pandemic. So, okay, we're buying fewer cars, but we're buying Mercedes, we're not buying Priuses. That's where this nation is. And that's, by the way, very similar in terms of the wine industry. I'm constantly reading numbers about how the wine industry is absolutely imploding and California wineries are going to be in a big problem. But while it is true that the gallons of wine being consumed is going down, what's happening here is the box of wine at the bottom shelf, which is consumed by sophomores in dorms, well, that's now being replaced by White Claw, okay? And what that means, of course, is if you were all hoping to get the discounted bottle of Open Swan in Napa, I got bad news for you. It ain't happening anytime in the near future. There's very little problem. Yes, I know there's increases in credit card delinquencies and auto delinquencies, but guess what? Credit card and auto debt as a share of income is still below where it was, not just in 2015, but 2007. Americans don't have a lot of debt. The highest level of household distress is bankruptcies and foreclosures, and by the way, those continue to be near record low levels, and house debt servicing ratios are also very, very low. You know, it's so interesting. I know interest rates are up, but it has not penetrated the bubble around American households, because most American household debt is in the form of something called a 30-year fixed-rate mortgage, which a lot of people refinanced back in 2020 at probably 2.75%, and you will pry that mortgage from my cold, dead hands. Sorry, I didn't mean to make that personal there. Labor markets are still tight. Jobs are still being aided. The unemployment rate's 4%. Job openings are down, but only down from the insanity of 2022. They're still above where they were in 2019. Wages continue to rise. And by the way, the biggest pace of wage increases we've seen over the last 5 years are for people who are typically behind the economic 8-ball. Women have seen way more increase in incomes than men have. Minorities have seen more than non-minorities. And of course, lower skilled people have seen more income growth than high skilled people. We are actually seeing some leveling of the economic playing field. I'm not saying that we're there and we can call it a win and walk away. What I am saying is the trends are moving in the nice direction. And wouldn't it be nice for once to take a step back and acknowledge the gains we are currently making, as opposed to constantly freaking out about the end being nigh. We just got a new inflation reading. It's down to 2% year over year. That's Fed target. And of course, interest rates have stabilized. Yeah, they've come up to basically where they were back in 2005, and now they've stabilized. Business investment still looks very strong. Corporate profits are at an all-time high level. Manufacturing, We're told our manufacturing sector is struggling. And look, if you just look at industrial production, well, it's not down. It certainly doesn't seem to be up. And we're not adding a lot of manufacturing jobs. But that being said, that's not how you look at the sector. Here's how I look at it. I don't look at it as total output. I look at it as value added. Value added, by the way, is what you add to those inputs. And by the way, manufacturing value add in the United States is at an all-time high level, as are manufacturing profits. I don't look at manufacturing and think, oh man, this sector desperately needs help. I look at manufacturing in the United States and I see a success. But again, that's not the narrative. And this is almost likely to continue. Why? Well, as I already noted, things are great. Real disposable income, all-time high level. Average household net worth, all-time high level. This is not an economy that's going to fold up and blow away with the tiniest of hits. It's just not going to do that. And in fact, these are broad-based economic gains. On the right-hand side, this is real net worth for the bottom 50%. How many have heard this idea that everything the bottom 50% has gotten has already been spent? Well, that's not true. Household net worth for the bottom 50% is still twice what it was prior to the pandemic. Now, again, I'm not saying wealth inequality isn't expanding. It is, but that's the top 0.1%, which we have shoved in our face on a minute-by-minute basis by social media and the internet. If you take a step back from that, for the rest of us, well, things look pretty good. And how about something as basic as poverty? We all know that the official poverty rate, which is based on gross income, is pretty low right now. It's running a little bit below 12%. But you see, that's not the right number. You have to pay attention to taxes being paid and benefits being received. That's the lower number. The CBO just did a new estimate, and they're including benefits which often aren't counted because, well, if you're just filing a standard tax form, you don't count your benefits on there. When you actually add that in, it turns out that the poverty rate in the United States right now is 4%, the lowest it has ever been. So yeah, I think we're doing a hell of a good job helping those less fortunate than us. Again, can we not take a step back and appreciate how far we've come? In fact, I'd argue, if anything, not only are consumers doing well, they're doing too well. Savings rates are dropping. Consumer spending as a share of GDP is back to an all-time high level, and you can see the overconsumption primarily in those external imbalances. The real trade deficit right now is $1 trillion. What does that mean? That doesn't mean we're being taken advantage of by our foreign trade partners. What this means is that the U.S. economy is consuming $1 trillion more than we are producing. That's on us, not the rest of the world. That is our choice to be overspending. Simple as that. You must be from Canada, right? I hear you. Although I heard it's your fault. Anyway. And of course, you can see that in the widening trade deficit, current account deficit, which right now at 4.5% of GDP is the second highest it's ever been. So yeah, we're on a spending and borrowing binge, and yet we want to blame the rest of the world for our troubles, as the case may be. And that's the weird thing. For all the good news I just gave you, what is the national mood? Well, consumer sentiment, again, as already knows, way down there. Consumer satisfaction is. High inflation made finances worse for 65% of Americans last year. Or globally, most people think that children will be worse off financially than their parents. Have we not seen Gen Z in action? Are you kidding me? It's just unbelievable. We think these things. Wealth inequality leading to a class war. Well, again, we're kind of moving in the other direction. And here's a CNN headline. The American consumer's on the ropes. Tariffs and anxiety could deliver the knockout blow. Tariffs and anxiety, the knockout blow. What are we talking about? Now, brings me, but where's the narrative? There are narratives in the reality, and they do not line up. And Robert Shiller wrote a book about this a few years ago, which for me was very inspirational, got me thinking about this, when he wrote a book called Narrative Economics, where he said you have to pay attention to narratives, otherwise you remain blind to a very real mechanism for economic change. But he wasn't the first. John Maynard Keynes said the markets are moved by animal spirits and not by reason. And my favorite philosopher, Will Rogers, said the thing that what really is the problem out here is not what you know, it's what you know that ain't so. I said it all wrong, but you get it, right? Again, this is the human condition. This is who we are. And that's true for California. Every time you turn around, you hear how terrible our state's doing, unless it's the governor. And it is true. Look, employment growth in the state isn't doing very well, and our employment has risen more than the U.S. overall. But put that to one side. Our output is growing faster than the nation. Our incomes are growing faster than the nation. Of the 3,000 counties in the United States, no fewer than 11 are in the top 100. We are still, by far and away, the highest income zip code on the block, so to speak. Our manufacturing sector, by the way, is doing great. California manufacturing is on fire right now. And it's not just electronics. We are seeing more output growth in manufacturing than Texas has over the last 5 or 6 years. California is actually still a manufacturing powerhouse. What about inequality? We heard our poverty rates are soaring here to all-time high levels, but yet again, even by gross income levels, they're near an all-time low level. And again, households from Hispanic and African American backgrounds have seen more income growth. If you want to really know what's wrong with our state, it's not complicated. The problem here is not that we have a weak economy. The problem is we don't have enough workers. Look, over the last 5 years, this nation has added about 386,000 jobs. But we've only added about 120,000 people to our labor force. Actually, when you think about it, that's a pretty good blend, 3 to 1. I'm still not sure how we accomplished that. And if you want to know what really depresses me, here's a number that depresses me. Why does Texas grow faster than we do? That's what we hear all the time. It's not complicated because they build housing. And what does that mean? That means their labor force grows. From 2020 to 2025, we added 120,000 people to our labor force. Texas added 1.7 million. Build housing. It's not complicated. But what about people fleeing the state of California? Well, I've talked about this. Got news. It is true, population's down. The number of households is up. The real problem in California is not that people are running away, but rather that people are doing so well, they're spreading out. But when you spread out in the context of a fixed housing supply, someone has to get out. We are driving people out of the state because we won't build enough housing. And you can see that as to where we are seeing job growth in the state. That is where you have housing supply and labor force growth. The Inland Empire has added 1/3 of all jobs by itself to this state in the last 5 years. The Central Valley has added the other third. The greater Sacramento is about 17%. It's all central part of the state. Why? Well, this is where you have housing. This is where you have labor force growth. Everybody in the Bay Area is panicked about the fact that they've lost 60,000 tech jobs. You should be a hell of a lot more worried about the fact that your labor force is down 150,000 people. That is the problem. And yet, we need to fix housing supply, and we have not done that. Oh, we've nibbled around the edge, but nothing has really taken. But all we can panic about is housing affordability, right? I mean, consider this. The share of renters laid on rent right now is near an all-time low level in the state of California, at an all-time low level. Everybody keeps talking about how we have high rent-to-income ratios. Yet if we have such high rent-to-income ratios, why are people per household in rental units also falling? Which they are. Right? So even renters are doing so well, they don't want to have roommates anymore. And stop talking to me about rent-to-income ratios, okay? Because what's really important here is not rent-to-income, it's what you have left over after you pay your rent. Take, for example, LA, my first city. Oh, it is true, we pay a higher rent-to-income ratio than most places. After you pay your rent, you have $42,000 left over. Anywhere else in the nation, you have $30,000 left over. In other words, even if you pay more of your income towards rent, it's still worth living in California. So yeah, it's a supply problem, not an affordability problem. But the only thing I'm seeing is no conversations about rent control, nothing about expanding rental housing supply. And that is our biggest issue of all. Now, how do narratives go astray? I've talked about this before. I don't have time right now. Wonderful books, Daniel Kahneman, Jonathan Haidt, Righteous Mind. It all points out something very simple. We don't think as much as we think we think. We respond emotionally to data. We don't respond analytically, as the case may be. And if you're wondering what that is, it's a whole bunch of people going up an escalator to a 24-hour fitness. We're not thinking as much as we think we're thinking. And you can't see that anywhere better in this graph. I just love this graph. I found it about a year ago. They just came up with a new version of it. This is the Federal Reserve, where they ask a whole bunch of people, how are you doing financially? And that top line is what people answered. And by the way, what that tells you is people in 2024 felt they were doing just as well off financially as they were in 2017. By the way, they're doing better off, but humans are inherently unsatisfied. I'm not surprised by that. What's really interesting here is when they ask these same people, well, how's everybody else doing? And that answer, by the way, is way lower. So don't understand what this means. This means that the average person thinks they're doing just fine, but the average person thinks the average person's doing terrible. It doesn't work like that. You know, I like to point out that 90% of parents think their children are above average. It doesn't work like that. It doesn't. I got 2 boys. I got a 7 and a 9-year-old. And statistically, one is a dumbass. I have come to terms with that. It is how it works. Simple as that. Another thing to keep in mind is, why do we have inflation? Well, the reason we had inflation is because the Federal Reserve decided to expand the money supply by 40% in 2020. And of course, they set off a massive asset bubble. An asset bubble causes an enormous increase in consumer demand, plus a 40% increase in money supply. Of course, it's going to cause inflation, right? After all, inflation is caused by too much money chasing after too few goods. Over and over, we were told that inflation is crushing American households. If American households were being crushed by inflation, inflation would stop. That's how it works. Inflation is a signal of excess demand, not a signal of a lack of demand. It doesn't work like that. Yet 70% of consumers feel inflation is outpacing income, and of course, inflation was a primary issue, and it came to that election last year. So honestly, what does this all mean? Well, who should Trump be thanking for his big election win? Well, none other, of course, than Jerome Powell himself, the man who set off the inflation in the first place. And I just love the irony of this, since he's made no bones of the fact that he doesn't want this guy around anymore, right? But here he is, Trump's in play, and now we have all these wonderful policies, and what does it mean? Well, I want to start with one of his issues, not trade. I'm going to start first with labor supply, and of course, immigration. As we know, we've heard news of ICE raids here and there, and of course, San Diego just had a big mess where they raided some restaurants, and there were flashbang, and there riots all came out, all this kind of stuff. But honestly, understand what we're dealing with here. The real problem in the United States and California is, of course, we don't have enough workers. Now, in California, it's because we won't build enough housing. For the rest of the United States, it's because we haven't had enough babies. And that's, of course, why the labor force growth, which used to be 1% to 2% per year, is now running, about less than 0.5% per year over the last decade. There's a very simple solution to this, which is more immigration, more workers moving here. Fix the legal system, get more people to move here, and we will have a rapidly growing economy. But we haven't fixed the immigration system. We're not even talking about it. We can't even talk about it, but guess what? They're coming anyway. They're coming anyway, some legally, a lot undocumented. And you know what? Thank God. Because in the last 15 years, this nation has added 15 million workers. Over half were born overseas. Let me repeat that. In the last 15 years, over half of all new workers in this nation were born overseas. Can you imagine how bad the labor supply shortage would be right now? Now, here in California, there's no surprise. 33% of our workers were born overseas. We're used to this. This is part of who we are. But obviously, this is leaving California. It's leaving the traditional border states. And that's why, of course, a lot of people are having issues with it. They're not ready for it. They're not used to it. And you can see the blend. Washington Post announces the economy's roaring, immigration's a key reason. On the other side of it, immigration was one of the top problems, according to Americans in the run-up to the election. It's a very odd place we're in. Now, of course, there's all this conversation about the millions of people that Trump wants to throw out. He's not going to throw them out, okay? Yes, there's some action here and there, but the reality is they don't have the courts, they don't have the police, and they don't have the detention facilities. They can't do it. Simple as that. So it's going to be smoke, not fire. That said, just having an anti-immigration regime is enough to slow down people coming into this nation, legally or illegally. And as a result of that, our labor force growth is slowing down yet again. And I did some basic simulations. I said, what would our economy look like under a Obama-type pace of immigration versus a Trump-type immigration, looking at the last 2 terms before 2020? And the answer is, if we go back to Obama level of immigration, we're going to continue to see labor force growth for the next couple of decades. If we go to Trump immigration levels, we are near max labor force. And that's not that's not good, considering that we have trillions of dollars of federal debt to pay off. Now, one of the things we have here in North America is we have these two other neighbors. There's Canada, we keep hearing about them. But there's this other country called Mexico. Anybody from Mexico? There we go, thank you. Thankfully, we have these two wonderful trading partners, because guess what? United States doesn't have labor force growth, but Canada and, of course, Mexico do. Mexico, you guys have babies. Canada, you guys have immigrants. It's a wonderful thing. And the result, of course, of that situation is labor force growth in Mexico and Canada has been growing at twice the pace of the United States in the last decade. Well, no wonder when we put the tariffs on China about 5, 6, 7 years ago, we didn't see onshoring, we saw nearshoring. We saw companies coming back to Mexico and Canada, more Mexico than Canada, but coming back to North America close to us. Now, of course, we have Liberation Day, where we're supposed to be slapping big tariffs on our two primary trading partners who have been filling in the gaps left over by a lack of babies, a lack of immigrants, and tariffs on China. And I love this to death. Why? Why do we need Liberation Day? Well, you know, because we need more factories and factory workers. This came off a recent poll. 80% of Americans say the country would be better off with more manufacturing jobs, but only 25% want to work in one. Isn't that wonderful? I love narratives. Now, of course, people keep asking me, what do the tariffs mean for the U.S. economy? And the answer is, I don't know, because I don't know what we're going to do. Every time you turn around, of course, he keeps pulling back. And it's even gotten to the point, you've all heard of the taco trade, right? Right? You know, because he's always going to chicken out, and so you just got to bet strong, go long when the numbers are down, and it'll eventually pop back up again. But with that being said, and I realize that this is not a standard opinion, but guess what? Moderate tariffs are not that big of a deal. And I know that's a shocking thing to say out loud, but you've got to understand that the U.S. economy is not that trade dependent. Now, if you're talking about, for example, a 20% across-the-board tariffs on all goods coming in the United States, Suzanne's giving me the stink eye over here. Let me pay it out. Let me pay it out. If you're talking about a 20% tariff across the board, you're talking about a $660 billion hit to the U.S. economy, okay? $660 billion tax. Who's going to pay that? About a third would be foreign exporters, about a third would be American businesses, and about a third of that would be American consumers. It's a $200 billion hit across $17 trillion of disposable income. It's not that big of a number. It really isn't. In fact, economists have said a 20% new across-the-board tariff on the U.S. economy will raise consumer prices about 2 percentage points. That's it. So no, the end is not nigh. That said, there are certainly certain sectors that would get absolutely pummeled. For example, the auto sector, cross-border. I mean, this is not buying stuff from China. We're talking about an integrated supply system that goes back and forth across the border multiple times, which is one of the reasons why we have wonderfully cheap, incredibly good cars. It's as simple as that. So yeah, not a really good idea. And of course, let's also remember, when it comes to California, we'd have a lot of imports and exports, particularly with Mexico, as the case may be, and our exports have to face the risk of retaliation. And that's when, of course, things start getting nasty. The real thing that worries me is not so much tariffs on imports, but, of course, foreign tariffs on American exports, which are going to hit American businesses, that are going to hurt, take, for example, for our wine industry, which was already discussed, as the case may be. So it's the retaliation and the tit for tat where it starts hitting specific industries in a bad way. And yeah, we don't need that. And of course, ag is the same issue as well. And remember, this is also having an impact on tourism and people deciding to come to the United States. And we're also feeling that in our hotels. And that's a hit as well. So it's a broader category than the tariffs specifically on American households we need to worry about. But for me, the biggest issue here remains the federal deficit and how we're funding the federal deficit. And I know that that seems like a weird shift, but let me explain. Look, the federal deficit is enormous. We all know that. We came into this year with the U.S. economy yet again on track to borrow federal government to borrow well over $2 trillion, which is an incredible amount of money, one of the largest full employment budget deficits we've ever seen. To give you a sense of how big it was, if you wanted to close it with more taxes this year, you'd have to tax every American household $15,000 more just to be able to close this deficit. Or you'd have to cut spending by 25%. So we have an enormous deficit. No, Doge can't fix it, all right? Now he's gone, but nevertheless, I still keep this slide for one of the funniest headlines I've ever seen in my life. This came out a couple weeks ago. Elon Musk discovers that serious spending cuts are really difficult. Gee, you don't say. And by the way, you weren't actually doing serious spending cuts, because what you're talking about here is secondary. And what's happening, even while he was running around trying to cut spending through Doge, well, of course, we're talking about a budget package which is going to raise the deficit by $2.4 trillion more than what it was already going up, given the deficit Trump had inherited. So yeah, this is not good. And again, understand the mirage that Americans are facing right now. This is, on the left-hand side, this is the savings rate we think we have. This is the savings rate once you include government debt. Here's a household debt we think we have as a percent of the economy. That's that lower number, 75% of GDP. That's great. When you throw in government debt, it's almost 200%. So once we start taking government finances and putting it on our accounts, we're not saving enough, and we have a lot more debt than we think. But we're acting as if we don't. So if we're not paying the bills, who is? Well, the answer, of course, the rest of the world. We have seen, particularly over the last couple of years, massive inflows of capital from the rest of the globe. Over $1 trillion net of portfolio investment in the last 2 years. $1 trillion hot money pouring into the U.S. economy. And of course, what that means is our net investment position with the rest of the world is by far and away the worst it has ever been. Now, what are people buying? Why are they pushing their money here? They're not buying treasuries. I mean, that's what it's going to, but they're not buying treasuries. What they're buying into, of course, is U.S. financial markets, our hot stock market, our hot real estate market. They're pouring money here because this nation right now has some of the best yields in the world, and financial markets chase yield. Now, over and over, we hear you should be chasing value, but they don't. They chase yield, and they just keep pouring money here, which causes prices to go up more, which creates more yield, which causes more money to come here. So yeah, they're chasing a bubble, and that's where it gets really dangerous. Yes, we have a stock market bubble. It's the second highest PE ratio ever. Housing prices are high only because there's not enough of it. As soon as supply catches up, prices are going to get back to something resembling normalcy. Commercial real estate prices are still high because commercial real estate has not yet fully acknowledged where interest rates are going. Oh, and let's not forget cryptocurrency. This is old. Bitcoin is now above $113,000. The capital market, the market capitalization of Bitcoin right now, the total value of all Bitcoins in existence, is greater than the value of Google. The overall market is $3.4 trillion. Oh yeah, but you don't understand. Yeah, I do. I do understand. And by the way, if Bitcoin at $113,000 is a little expensive for you, may I suggest you invest in Fartcoin? No, look it up. It's the real deal. It's traded, people. When I picked this up, it was $1.11. It's above that now. Sounds funny? Has a market capitalization of $400 million. Yeah. What in the hell is happening here? Well, of course, as Warren Buffett said, be fearful when others are greedy. And got news for you. People are being greedy. And that, of course, is what ultimately is funding our federal deficit. Now, throw in, of course, what happened a few weeks ago, because you saw where this goes. Trump was going to go through with some serious tariffs. The market started diving, and typically the bond market rallies and interest rates fall. Didn't happen this time. Why? Because when the stock market started to drop, the foreign capital started turning off, and the dollar started to drop. And when the dollar started to drop, interest rates went up. And suddenly we see where this thing is going. Look, I understand economists have talked about the federal debt for decades and decades, and we're all bored of it, including me, and I'm an economist. But what I'm talking about here is not the debt per se, but how we're funding the debt. Right now, our deficit is being funded by massive capital inflows, and when those capital inflows turn off, we have to self-fund, and self-funding can only take place with another enormous increase in interest rates. Now, yet again, does that hit American households? Not if you got a 30-year fixed-rate mortgage. But it is going to hit the federal government. And the question is when is the federal government finally going to have to break and make Americans pay for what we're receiving in terms of the federal services and goods we receive on an annual basis? And the answer is I don't know. But I understand the problems. And of course, it's not just the federal government. We have a massive deficit in the state of California, which was created by exactly the same bubble. And no, our deficit problem right now was not caused by Trump. It was in play all the time. And of course, it's right down to local levels, as the case may be. Now look, I look at the data, and I can sum it up this way. This is the last bunch of administrations starting out. And what's so interesting about where we are, Trump has inherited, statistically speaking, the healthiest set of American households ever. And yet, people are angry. People are upset. At the same time, he inherited an economy that was wildly out of whack, wildly out of balance, borrowing trillions of dollars from the rest of the world. And yet, financial markets seem perfectly happy. You talk about a bizarre circumstance of narratives versus realities. Look, I'm not specifically worried about Trump, but I am worried about the U.S. economy. And of course, Trump's efforts are likely to destabilize a very unstable situation. Obviously, what we all need to do is take a breath, take a step back, and figure out how to defuse the bomb before it goes off. But that's not happening. We have growing risks, strong economic momentum, there's no doubt about it. But with that said, all this turbulence is threatening the capital inflows that we are currently relying on. You want to know what thing to look at more than anything else? You look at the dollar. Watch the value of the dollar. When that thing starts to drop significantly, we're going to see a big increase in interest rates. And that's going to really upset the apple cart here in the United States in all sorts of different ways. How do we respond? How do we react? What do we do? The answer is there's 100 answers to that question. It all depends on what narrative's in play. And of course, here in California, look, I come up here to Sacramento, you walk down the street to the Capitol building, and you would swear we were in the middle of World War II fighting Nazi Germany. No, we do not have a massive social emergency in the state of California. We have one problem. We don't have enough housing. And if we could put aside all the other nonsense and focus on getting real solutions to that one major issue, a lot of other things would be solved, not the least of which would be budget deficits. California has a really interesting out that most governments don't. We just have to build housing. People will move here because we live in the nicest place in the damn universe. But they can't do that unless we let them. And we don't seem to be willing to do that. And that's on us. It's not on Trump. It's on us. Every city hall, every planning commission, it's on us. But in the end, it's because of the narratives. And the narratives are running amok, and it keeps pulling us down all the wrong rabbit holes. We need to learn to fix the narrative, because as the wisdom of one of the great ancients, Mark Twain, said, it is easier to fool people than convince them they have been fooled. And man, have we been fooled. Thank you very much, everybody. Always wonderful to be here. And with that,